What are the key points that JPMorgan is actually highlighting in this move?
Thank you, Rashad. So it is a momentous day, actually, if you might allow me to say that, for the Indian bond market, which has been in the making for many years now. So India was the last big emerging market that has been outside the global bond indices. And JPMorgan is the first one which is adding Indian sovereign bonds to its emerging market indices. The inclusion will begin in June of 2024, and it will be India will get a 10% weight on the index, which is the maximum possible, and it would be kind of spread over months with a 1% weight kind of incrementally being added each month. The JPMorgan indexes tracking emerging markets roughly track around $236 billion of assets under management. So roughly, analysts are saying that over this period, we could see $25 to $30 billion of passive inflows into the Indian bond market, which apart from the front running, which we should see before the actual inclusion begins. So given that the Indian bond market is very insular with a foreign ownership currently, which stands at only around 2% of the total outstanding Indian government bonds, it is a big thing for the market.
Now, what does it actually mean for sovereign bonds? And, you know, how much money, what sort of numbers are we talking about with this inclusion?
Yeah. As I mentioned, so we are looking at, just with the JPMorgan inclusion, we are looking at $25 to $30 billion. And there are other global index providers also, with FTSE Russell coming up with their decision later this month. So we are looking at 50 billion if all the index inclusions come through just by way of passive flows. It means a lot for the Indian bond market. It will help change the dynamics of the Indian bond market, which has perennially has seen a bit of an oversupply given the widening government fiscal deficits over the years and the need to borrow from the bond market to meet that deficit. So now foreigners will be expected to play a bigger role in the bond market with this inclusion, and basically that will help bridge the demand-supply gap to some extent. Citibank is expecting the 10-year yield to drop to 680 in the coming months, which is quite about a 30 basis point drop from the current levels.
Very quickly, what about the demand-supply equation here? What does it mean for yields as well?
Yeah, so yields are today we've seen a bit of a knee-jerk move, of course, given the decision came through late last night, and this will provide a good kind of bulwark support to Indian bonds at a time when we are seeing U.S. yields have been rising, the rupee has been hovering near its record low, as well as crude oil prices flaring up. Remember, crude prices tend to play a bit of havoc with Indian debt, given the large inflationary impact that it has on Indian markets. So given all these headwinds, the decision to include India and the flows that will come, it will kind of act as a stabilizer and a support for the Indian bond market.